factors. You can also manipulate your currency for the purpose of trade. For example, China does this. They do this a great deal with the goal of increasing their exports. So if China's money is very cheap, this means that we in the United States can buy more stuff from China with the same amount of US dollars. So the Chinese central bank actually prints a great deal of money to ensure that the price of Chinese money is artificially low, despite the fact that natural market economics would want to appreciate the value, increase the value. And this is done to make sure that their factories are always working so they can have lots of jobs. This is kind of a complex topic, but there's a gentleman named Sal Khan who created a series of completely free courses on Khan Academy, which not only discuss banking, but actually discuss how China manipulates their currency here, foreign exchange and trade. And if you're really curious about how this works, I'd highly recommend just creating a free account and watching these lectures. They're about 5, 10, some are about 15 minutes long, and each and every one of them explains a certain component of how banking or foreign exchange or how currencies work. And then after you watch all of them, you'll have a pretty strong understanding of how central banks manipulate currencies for the benefit of the societies that host them. There's also an incredibly deep system of interconnected banks, regulatory agencies, and treaties built around easy conversion of one money to another. So when we used the example of purchasing an Xbox from England, where you take your US dollar and you exchange it somehow, some way into a pound seamlessly, and that person selling you the Xbox receives pounds for payment, and then he ships you the Xbox, and then you get it as if you went down to Walmart and purchased it. This is only possible because of treaties, regulatory agencies, banks, and a lot of magic working behind the scenes. It's very complex magic, and it's very hard to maintain. It costs tens of billions of dollars, a lot of inefficiency, a lot of mistakes are made. And so it's a complex topic. The Bretton Woods Agreement is really an amazing thing, too. If you look it up, it happened in 1943 as a consequence of World War II. The Allies believed they were going to win the war, and they started having a discussion about how they were going to rebuild the world's money system. And because the United States was the principal victor, and because the other alternative was to embrace the Soviet Union, we, the United States, received a significant upper hand in these negotiations, basically becoming the default reserve currency of the world, which benefited our economy and our interest rates tremendously and helped us grow so quickly after World War II. So I'd highly encourage you, if you're curious about this, to read about the Bretton Woods Agreement and also to take Sal Khan's courses, and you'll get a stronger sense of how magical and rich this system has to be to allow one person to purchase some item in a country they've never been to and have that happen seamlessly and money to move around as quickly as it does. Okay, so how does the Bitcoin supply and demand of money work? Well, what's really interesting about the Bitcoin is it behaves like a commodity where we already know how much exists. So imagine if we knew where all the gold in the world is, and we knew how much gold that is, every rock of it, and we understood how much time it would take, and we created a constant rate at which the gold would be extracted. This is kind of the situation with the Bitcoin. Because of algorithmic constraints, which are now enforced by every single node in the entire Bitcoin network, meaning it's practically impossible, unless you get the entire internet to agree, to change the supply. There is no way to ever have more than 21 million Bitcoins. Furthermore, we also understand the rate at which Bitcoins are produced. By algorithm, this is constrained to be approximately 10 minutes right now for every 25 Bitcoins, and every 4 years that is reduced by half. So we just reduced it from 50 to 25. The next reduction will be 12.5. And if you do the math, this will tell you that by the year 2140, we'll have every Bitcoin ever in existence, which is an incredibly unique concept. It's really an amazing thing. Because the supply is fixed, the currency is intrinsically deflationary. You may have heard things like 98% of the value of the US dollar has been destroyed since 1913, and that's absolutely true. If you held $1 in 1913, today's dollar is only worth 2% of that. whereas the Bitcoin is intrinsically deflationary, which means that every single year, if it survives as a currency, it has to gain value because there is going to be more demand, whereas the supply is relatively fixed in relation to demand, the value per Bitcoin will go up. Now, the reason why this does not yield a phenomenon called deflationary spiral is that the Bitcoins are completely divisible. And they're divisible to basically as many digits as we algorithmically wish to enforce. Right now, it's 8 digits. So you can have practically unlimited fractions of a Bitcoin in circulation and price them very nicely comparing to other currencies. There has never been a digital deflationary currency. So unfortunately for us, we're kind of, and actually fortunately too, it's kind of a double-edged sword. We're in a completely new no man's land of economic theory. No one's tried this before. We've had currencies that are based upon a commodity. Like, for example, the US dollar up until the 70s used to be based upon gold, which theoretically meant that you could go to a Federal Reserve Bank and take one of your dollar notes, hand it to them, and they would hand you that value in gold. And up until the 1970s, you could get, for $30, a troy ounce of gold. I think the price is now around, $1,400, $1,500. It changes every now and then. But in the 1970s, you could actually just go and exchange US dollar for gold. Fortunately, it was fractional reserve, which meant we had many, 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 many times more dollars in circulation than the U.S. government had gold on hand. So if everybody tried to change their dollars in for gold, it would be equivalent to a bank run. They would break the bank. So we decided to just remove the gold standard completely and go to a total fiat currency, meaning there's nothing backing it. Whereas the Bitcoin is kind of like that in terms that it's a deflationary currency as if it was based on a gold standard, yet it is backed only by algorithmic constraints, and it's infinitely divisible. So while it's deflationary, the deflationary nature does not seem to interfere with commerce. So we've never had this before. We've never tried to mash a commodity-based currency with a digital currency and completely decentralize it. It's an experiment, and it's really an amazing experiment if you like economics. Interestingly enough, as more people use the Bitcoin, which is very likely going to happen because of low transaction fees and anonymity, demand will dramatically outpace supply, which means if you are an early adopter of the Bitcoin, and people were buying them a few years back for 10 cents a piece, you probably are a millionaire today. And that's just how it works when you're an early adopter of anything that takes off. Imagine if you were one of the first employees at Google or at Microsoft or at Apple. You'd be a very wealthy person today. And it's the same deal with the Bitcoin. It all has to do with the utility it provides. So the Bitcoin, to recap, has a steady supply, which is algorithmically constrained. No one entity can manipulate that. And you'd have to get every person who holds Bitcoins, the entire network, to agree, which won't happen. Because it's fixed, the currency is intrinsically deflationary. Because there is a natural demand due to anonymity and low transaction fees, the price will increase. And we don't have economic theory to talk about at what rate this is going to decrease and what long-term effects this is going to have. Okay, so let's talk about money exchanges now. So in general, money exchanges are called forex exchanges. Kind of a simple term. If you're curious about it, I would recommend you go to this link right here. Forex is a good way to make money if you're willing to invest a couple of years of your life and a couple of thousands of dollars in painful, terrible mistakes. But Investopedia has a wonderful series of tutorials on how foreign exchange works. And to further your understanding of money and currencies, I'd highly recommend taking these tutorials and perhaps even buying a book on Forex to get a better sense of how currency is traded. Because the Bitcoin, just like dollars to euro or dollars to pounds, is in itself a foreign exchange. Interestingly enough, the currency exchange markets are the largest markets in the world. If you think oil is big, oil is a small market compared to the money markets. Forex exchanges are pretty amazing and remarkable structure. They're usually, whenever you're dealing with a market as intricate, complex, and large as the foreign exchange market, you're going to attract some incredibly sophisticated investors, people who spend their entire lives to figure out how to do something 0.05% better than the competition. And to give you a notion of how valuable these people can be, I've included a job link. So this is a job for an algorithmic trading Forex company. It's in Paris, Geneva, and London, so there's probably a couple of jobs available. And the starting rate is £250,000 to £500,000. And some cases, the salary is even larger. And this is just one job. These are called quantitative analysts. And their job is basically to construct financial products, not only for foreign exchange markets, but for basically any market, commodities, equities, long-term security, fixed income securities, and this should give you a sense, though, of the amount of money that is being handled here and the utility for figuring out how to manage risk while trading these kinds of money. So money exchanges are a big deal. What's really also unique about money exchanges is that unlike stocks and bonds, where the United States historically has not really taken a strong interest in other than just regulation. They don't take an ownership position. Like the United States doesn't say, we're going to purchase this many shares in Microsoft, up until recently with the auto bailout and the bank bailout, amongst other things. Generally speaking, nation states do not participate in equity or bond markets outside of what they must do to stabilize and keep their currency running. Money exchanges, on the other hand, sovereign nations tend to deal with them. They tend to not only regulate them, but have a vested interest in using money exchanges to affect whatever outcome they desire. For example, the Chinese government uses exchanges to ensure that the value of the yuan is low, the renminbi is low, so that they can go ahead and continue having very high exports to keep their economy going. So this, as you can imagine, adds a considerable amount of complication to the analysis and management of portfolios within money exchanges, forex exchanges, because you have not only regular everyday people, but you also have governments playing around and toying with things. Now, in terms of Bitcoin exchanges, right now the market is only 4 years old. And as with any new market, you expect a small group of people to control most of the exchange. And it's only reached about $1 billion in capitalization. And the largest exchange is Mt. Gox. We're going to have an entire lecture on Bitcoin speculation, where I'll show you in more detail Mt. Gox and talk about the Bitcoin price and how people make money through speculation. But for the purposes of this lecture, just be aware this is one of the websites that you would go to go ahead and speculate in the Bitcoin industry, i.e. exchange your money, whether it be euros, yen, US dollars, into the Bitcoin. If you so chose to transfer your money into Bitcoins, the current market price is $92 for a Bitcoin. When I first started buying Bitcoins, they were 10 cents. So these markets are pretty amazing. This went as high as $266 not too long ago. In fact, you can see the price spike up here. It's pretty volatile. So that's why we're going to have a whole lecture on it. Mt. Gox is responsible for a large chunk of all of the Bitcoin transactions as of now. That said, venture capital has begun investing millions, literally millions of dollars in developing not only new exchanges, but also financial products to better serve the needs of Bitcoin speculators and Bitcoin merchants. I will discuss this in more detail in my speculation lecture, but for the time being, just be aware that there's a lot of interest in basically